Welcome to this video on accounting, double entry bookkeeping, in particular looking at the day books and looking at how we transfer the information from the day books into our ledger accounting. Just before we start, there are four main day books that we'll concentrate in particular in this video. The first one is the sales day book. So this records all your credit transaction to your customers, i.e. the sales that you make. And then you also have the sales return day book, which is your customer returning some goods back to you. And you have a purchase day book as well that you need to be thinking about. These are purchases made on credit to your suppliers, and they'll be recorded in the purchase day book. And then you'll also have a purchase return day book as well. So these day books are really important to understand what happens in the day books, and we're going to transfer the information from the question into these relative day books. So the question I'm going to use is Lorna Pratt. It's taken from one of the textbooks as well, actually from David Cox's textbook. But if you don't have that available, you can take a picture of the following screen. So you have most of the question here, and then if I scroll down, you'll be able to take the remainder of the questions as well. And there you go. Okay, so we are going to first of all enter the above transactions into the appropriate day books. And like I said, we are going to in particular use them 4 day books that we discussed. And remember, the 4 day books only provide transactions which are on credit. Okay, to begin with, we're just going to ignore these balances here for now, as they don't have much relevance until we start putting them into the ledger accounts. So we'll start with the first transaction. On the 2nd of January, you bought goods on credit from Maxtrad for £2,900. So if you buy goods, you will need to put this into the purchase day book. So the day books look very similar to what we have here. You would just have date, details and amounts. So I've just got some templates pre-made. So we're going to call this the purchase day book. Okay, sometimes this is also referred to as a purchase journal. Bear that in mind. So the date is the 2nd of Jan. The details is the name of the person that you've made this purchase from. And the amount was £2,900. Okay, so that kind of ticks off this first one that we've done. Okay, and you do the same for the second one. On the 3rd of January, you bought goods on credit from Amtosh PLC, £7,500. Again, you do the 3rd of Jan. This time it's Amtosh PLC, and the amount is £7,500. Okay, so you will go through this list yourself normally and put these into the relevant day books. So I'm going to pause this video now, and I will complete this and come back with the relevant answers. So again, if you've not taken a picture of the question, make sure you do that at the start of the video, so you've got all the transactions here and available to you. Okay, so if you just pause the video now, and then I will be able to come back with the answers. Yeah, so hopefully you managed to do that quite successfully. So the purchase day book, the total of this would be 17650. The total of your purchase return day book would be 2023. You should also have a sales day book and a sales return day book. So the sales day book represents everything that you've sold to these following customers, and that should be 19699.10 in terms of your total. And your sales return is customer returning stock back to you, which should total 144.54. So you have the totals given to you in regards to how you're going to use this information to move on. So the next part of the question, if you look at the actual question itself, it's asking you to record the entries into loan plats ledgers and transfer the appropriate amounts to the income statement at the year ending 31st of Jan. So let's do the first thing. Let's transfer the amounts to the appropriate ledgers first, and then we will think about how we're going to transfer the amount to the income statement. So for this you will need some T accounts. So you will need 3 ledgers as you normally do. So we're going to start off with a general ledger. Okay. You will also have a payable ledger. And you will also have a receivable ledger. Okay. So you should know from this that we hopefully have the right amount of ledgers and so on. Okay. So I'm going to deal with the general ledger first. And in the general ledger you have the sales account, your purchase return, and your sales return account. So for your purchase account, what you would have to do is as follows. So the purchase account, if you remember pearls, so if you remember pearls, if there's an increase in purchase expense or an asset, it goes on the debit side. If there's an increase in revenue, liability and sales, there's an increase on the credit side. So regarding the purchase account, you would do the 31st of Jan as the date. So instead of putting them separately, which would be pointless because you will be repeating all the information from the purchase day book. So instead of putting them as separate transactions, we are just going to put the total amount instead. Okay, and we're going to call this the purchase day book because that's where we have got the information from. So we are going to call this the purchase day book. Okay, and the amount is going to be how much was it? Was it 17,650? Okay, and then you do a similar thing for a purchase return account. Okay, purchase return is, if we're thinking about pearls here, if there's a decrease, the side swap. Okay, so pearls are written backwards if there's a decrease. And a purchase return is actually a decrease in purchases because it means that we have returned some of the stock back to our suppliers. Again, I will go to my purchase return day book. The total amount is 2023 and that's the amount that I would use. So again, I'll put the date 31st of Jan. I will put purchase return daybook, and I will put the amount of 2023. Okay, and I'll do a similar thing for my sales and my sales return. So I'm just going to pause the video here again, and I suggest you do the same just for practice with the sales account and the sales return account, based on identical on how I did the purchase and purchase returns. But just think about your pearls and think about how you're going to on what side you're going to put the transactions on. Okay, so hopefully you've managed to complete that without many issues. So you'd have your purchase from your purchase daybook, your purchase return from your purchase return daybook. You would then have sales from your sales daybook and your sales return from your sales return daybook. So we're just going to leave that for now and then go on to our payable and receivable ledger. Okay, so in our payable ledger you have a list of suppliers that you owe money to, and from this transaction, if you look at your purchase daybook, from the purchase daybook you can see you have two suppliers. The first one is called Maxtrad, the second one is called Amtosh, and these two transactions relate to the same companies. And also in the purchase return will indicate you got two suppliers, again Maxtrad and Amtosh. So this is why I've only made two T accounts or two ledger accounts in relation to that. So what I would do here is give the correct names. So the first one is Maxtrad and the second one is Amtosh PLC. Okay, so just bear in mind this account here, if you're thinking about pearls, this account is a liability account. Okay, so this side here would increase the liability, this side here would decrease the liability. So if we owe the supplier more money, it's going to go here. If we owe the supplier less money, it's going to go on the debit side. So just bear that in mind as we go through this. Okay. So if you make a purchase, for example, you made a purchase here of £2,900, that would have to go into the credit side of the account because this would increase our liability. So let's put that straight on there on the 2nd of Jan for that particular amount. Now before we do that, we actually need to go back to the question because the question does give us some balances, so we need to put them balances in first. So just before we forget, is these questions here. Okay, so in the payable ledger you have a balance of £1,005.70. So £1,050.70. So let's put that balance here, and again I'm going to put this on this side here. So I'm going to put the date, which is the 1st of Jan, and this is called the balance brought down. So it's brought down from the last month in the value of 1,050.75. Okay, so this is really important to remember to put the balances in first. It's quite easily can be missed out if you don't fully read the question. So let's again now deal with this one here, the 2nd of January. So this is how much we owe them at the start of the month. So we make some more purchases on the 2nd of Jan, and this would be cross-referenced to your purchase account for the value of 2,900. So this is how much more we would owe our suppliers, hence we've increased our liability. And then another one on the 18th of Jan, you make some more purchases, and we do that for 1,750. Now if you look at our purchase return account, there's two purchase returns that we have as well, on the 10th and the 23rd of Jan. We need to put them on the debit side of the account because they reduce the amount that we owe to our supplier. So let's do that, the 10th of Jan, and that is a purchase return, and the amount for that is, the first one was 319.75, and then we have the 23rd of Jan. Again, it will be a purchase return, of 953.07. Okay, so I've done the first one for you from MaxFed. Again, I want you to pause the video and have a go at doing Amtosh, and in your receivable ledger you will have two customers, I believe, that owe you money, and these two customers, if I can just find, here we go. So these two customers would be Mayford and Carp Minister. Okay, so because there's no other names apart from them two, so let's put them here. So we put Mayford and Carp Minister. So again, have a go, pause the video, have a go yourself first before I reveal the answers. Okay, so you can see from the completed T accounts for in the payable ledger and the receivable ledger as follows. So I'll put all the transactions as I mentioned. Just be aware that the receivable ledger would be considered to be a asset account. Okay, so with asset account, this side would increase the asset, i.e. you are owed more money. This side would decrease the asset, i.e. you are owed less money. So just bear that in mind as you go through the receivable ledger. So the question is also now asking you to transfer the appropriate amounts to the income statement, and also we would balance off those accounts that need balancing. So those accounts that go in the statement of financial position always need balancing. The income statement accounts would need to be transferred to the income statement. So let's start with balancing these accounts first, and I'll show you how to do one so you can do the rest yourself. So because the payable ledger, trade payables go into your statement of financial position, they have a value, meaning they have a balance which will be carried forward to next year or next month, or however you do the accounting period in terms time wise. So you would need to balance this account, and the way we would balance this account is as follows. You would first of all add up the highest side. Okay, so step number one is to add up the highest side, and I'll do this in red. So in this particular scenario, this side seems to be higher, and this side adds up to 5,701. Sorry, 5,700.75 pence. And this total, because it's the highest total, it also goes on the opposite side as well. 5,700.75 pence. And it's common practice to double underline this. It's probably better off using a ruler. So just make sure you do that. So what do we do next? So at the end of the month, on the 31st of Jan, we have a balance carried down. So this is the carried amount that we need in order to make up the total that we have here. So we would take away from the answer of 5,700. So we would do 5,700.75 minus the 319.75 minus the 953.07, which will give us a balance carried down of 4,427 and 93 pence. Okay, this balance is then transferred to the opposite side. 31st of Jan, but this is called the balance brought down, and this is always below the total. This is always above the total, this is always below. The amount is the same. So next month, when they decide to do the accounts, they don't need any of the information and they can just start from there. So they won't need any of that information, they can just start from a new balance and do the account for the next month and so on. So that's how you would balance do 4 accounts only, and if you want to pause again and go through them 4, that would be perfectly fine. Okay, just a correction, this date should always be a date after the balance carried down, so this actually should be the 1st of Feb. So that was just a slight error, in the sense that it should always be the day of the next month or the next. Okay, so you can see from here in terms of the balance brought down and the carried down amounts. So you can just check yours with mine, making sure it's all correct and so on. Okay, now in terms of transferring the amounts to the income statement, you need to go back to the T accounts that you did for your in your general ledger. So here, for example, you have a purchase day book. The purchase day book would then be transferred on the 31st of Jan. We would basically, the transfer of the income statement, we would just write income statement and the same amount of 17650, and that's all we have to do in terms of transferring the amount to the income statement. It's the amount that would go in your income statement as purchases as part of your cost of sale. So this is all you have to do in regards to that. It's also good practice just to total both sides up as well. Just for presentation purposes. Okay, and that's all you would have to do. So again, pause the video and I will allow you to complete the rest and transfer the rest of these accounts to the income statement. Okay, so that's how you transfer the amounts to the income statement. So hopefully you've got something similar to what I have here, and it should be relatively straightforward in terms of doing that. So this kind of concludes this particular question. So hopefully what we have learned from here is how to transfer this raw information into our day books, and then how we transfer the day books into our ledger accounting. So thank you for watching this video. Please do like and share it if you found it useful. Thank you very much.